we're going to talk about real estate and how to invest in real estate through the stock market. So, first things first, what is real estate? Real estate is just a term used to describe property, mostly land in relation to housing. So whatever house is on that land is referred to as real estate. And for the most part, is usually either apartments, commercial buildings, houses, among other things. Even what do you call them? Parking lots. We have parking ramps. So as long as something takes space when it comes to land, and that thing can be used to generate cash, then for the most part, that's real estate. So you see, some real estates invest in real estate companies, invest in amusement parks and the likes, because they know it's going to take space, physical space, and that space is what is more valuable than anything else. So real estate is a very lucrative business, and that's because wherever you are, there's a house where you're living. Wherever you go to shop, there's a building there. Wherever you go to, whatever it is that you want to do, fix your car, buy goods and services, most of this stuff are done in a building, and that building is owned by someone, which is in essence real estate investment. So someone decided to put their money into that building, and then that building now generates income in form of rent, among other sources of income. Now, on this poster here, down here on the right, there's a traditional way of investing in real estate, and on the left we have a modern way of investing in real estate. So traditionally, it used to be said that owning a house is an investment, which means you earn your income from whatever job you're doing. You take that income and you go buy land or buy a house, probably get a mortgage in the process, or otherwise save and save and save until you get to a point where you can buy a house. And that's just symbolized by those keys that someone is holding there. You hold those keys and you feel like, yes, I am an investor. I've invested in a house, and therefore I've made a sound investment so far. Now, that form of real estate investing was one of the crudest way of real estate investing, where you invest in a house in which you yourself stay in. So a lot of single family homes and all that used to be a thing of the past. Like you'd want to own a house, and therefore own a house to raise your kids in, to have a family living, and the likes. But then over time, people realize that there are people who cannot afford to buy a house or build a house or own a house. So they decided to build houses and rent it out to other people. And that's when apartment buildings started coming up, where you had rental units. You had the rental unit, people would come in, rent a room or two, or it's sometimes usually 1 bedroom, 2 bedroom. Our very own famous Kenyan rental units called bed sitters. You have those. Those are some of the ways people invest in real estate. And that means you go buy a piece of land, and then you put up a building on that piece of land, and then you rent out that building, and that's it. Now, other people realize that, I can own a shop. So I have to build a building, and that building is called a shop. And in this shop, I'll put my business in that shop. And therefore, that's that. And then over time, if I feel like I don't want to own that business anymore, I can rent out that building to other people who can use that building to do other businesses. And that's when commercial real estate started. But then there's been a lot of developments in the real estate sector, and not just the type of housing that is built, but also the sizes. You know, it's no longer single family homes, it's more like multi-family homes, huge apartment buildings. You get stories upon stories of apartment buildings. You get a lot of commercial spaces. Now, I know you've all realized that there's a lot of malls and shopping centers that are being built all over the place. There's a lot of commercial buildings that are out of the norm, skyscrapers and the likes, you know. So all these sorts of buildings is now the new age way of real estate investing. You build a massive building, you're now looking into, you know, maximizing the potential of land, because a place where maybe you'd have a 2-family home previously now has an apartment building with like 100 apartments. So that has been changing over time, more skyscrapers, more apartment buildings to accommodate more people. As population grows, more people will need housing, more people will need places to do business. Now you have business in different floors of a building and the likes. And then the other iteration of real estate investing is student housing. So you get to campus and you're there and your campus cannot offer you accommodation. Then you have to figure out a way to accommodate yourself outside of the provisions of your university. So that's when student housing started coming up as a lucrative way of real estate investing. So you go build something like an apartment, but not family oriented, more like single person apartment buildings. That gave rise to the bed sitter kind of stuff, you know, because, you know, it's only one person living here. They don't need a lot of space. They don't have children. They don't have, you know, a lot of property as in furniture and the likes. All they need is a bed and a place to sit and study, and probably a kitchen and a bathroom. So that started growing the student living residential or real estate. And then over time, we've had now developments in that sector where other companies like get into that sector and now maximize the potential of that investment. Now it's no longer one person building, you know, a building with 3 units or 5 units or 10 units. Now it's a whole, say, apartment building, but just for students. And then that keeps growing. Every day there's always something new in that sector. So real estate traditionally has been, you go buy a piece of land or a plot or whatever it is that you're buying, a section of a space. On that space, you build a building. Could be a single family house or a multi-family house or an apartment building or a student living building or a commercial building. And for the most part, that's been the case, generally speaking. People have known real estate as buying a land, building a building, and then renting it out. And now, how do you earn from real estate in that sense? For the most part, you earn through rent. So people pay rent, and then that's how you make your money. Then you use that money to either pay back the debt you used to build the building, or if you build the building cash, and then that will be your source of income or cash flow. Now, over time, there's been developments in real estate investments, and now we have the new or the modern way of real estate investing. So real estate investing in the modern way, we have what we call REITs or real estate investment trusts. So This is just a pool of funds from investors, and they use this pool of funds to build buildings, whatever it is that the real estate investment trust has as a strategy. So they could be doing commercial buildings, they could be doing residential buildings, they could be doing student living apartments. So they go and ask investors to invest in them, and they pull that money and they go and build, let's say, an apartment building. And then the investors gain by, when they rent out those apartment buildings, they have that cash flow. And then the investors gain by sharing the profits out of that real estate investment trust, or whatever cash flow that comes through from that investment. So now it's no longer one person investing in a real estate, but a group of people joining hands to invest in real estate, and therefore end up making money without them actually owning the building physically, or managing the building physically, or participating in the active investment of that real estate. So this has been a game changer for the most part, because now with the rates, you can start with very low amounts. So if a house costs, let's say, 500,000 Kenya shillings, you could buy a rate for less than 100,000. You could buy, that is a multiple shares of a rate for less than $100,000 in total, 100,000 Kenya shillings in total. So this has been great, because now people who were not able to invest in real estate can now invest in real estate through rates. And rates are just like stocks, because this is like a company, and its mandate is to build apartment buildings and therefore invest in apartment buildings or whatever it is. So this is like a company, just like Safaricom, just like Amazon, or just like Facebook. A rate is also a company where you can invest in as an investor. Now, rates are available in different markets. In Nairobi Stock Exchange, I think we only have one. But in the US stock market, there is a ton of rates. So these rates are usually regular stocks in the stock market, where you just go and you can buy a share today and sell it tomorrow. And that's the thing about now the new, the modern way of real estate investing, where you can buy a rate, hold it for 2-3 months, and sell it. Unlike building a house, where if you build a house today, chances are, even if you want to sell it tomorrow, it's not going to happen that way. You'll have to go put it out in the market, try and look for people to buy the house. The whole process of selling that house will be very, very cumbersome. It's a very expensive affair. You will probably need a broker to go, or a salesperson, or have the property under a real estate management company where they put it out there for sale. So the process of converting your investment into cash in the traditional real estate investment was very cumbersome. And now we have the new modern way of real estate investing, where you could just buy 10 shares of a real estate investment trust. You get your dividends. That's the advantages of investing in rates. You get dividends. And then if you feel like, you know what, I want my money back, I want to liquidate my investment, you can just sell it, and someone else is ready to buy those shares. So far we've looked at the traditional versus the modern way of real estate investing. And what stands out is the advantages of modern day real estate investing through rates, and that is liquidity. We also have dividends. You earn dividends when you invest in rates, because rates usually pay out almost, or at least 90% of their profits to their investors. So dividends, in terms of the profit that the company makes, is shared to you as the investor, up to almost 90%. As compared to the traditional way, you get rent from tenants. The other advantage of investing in REITs is the ease of the investment process, which is all you need to do is buy a REIT or through your broker and hold it and earn dividends, and then when you want to sell it, you can just sell it. But the process of owning a physical real estate is very cumbersome. It has a lot of things going on. There is active management of the building. That is, you want to know if the building is being, the tenants are taking care of the building, as in they're not destroying the building in the process. You want to repair and do maintenance all the time. You want to do, if a tenant leaves and another one comes in, that process of onboarding tenants and letting go of tenants. There's a lot of physical work that is involved in managing physical real estate that is not related in rates. So with rates, all you have to do is just buy the rate. You don't even have to go to their offices. You don't even have to know who they are or what they do or whatever. But if you know that this rate is a good rate, they pay good dividends, that's it. No more work. You buy the rate, you own the rate, and that's the end of the day. So other than that, there's obviously differences in terms of taxation. So if you are trying to save, you get some tax relief, you can use physical real estate to do that. But that you have to talk to your tax agent or your accountant and see what advantages can I get by owning this type of building. For example, owning a family house, that is a single family house, versus owning a set of apartments or an apartment building versus owning a commercial building. They all have different tax advantages. Some have better advantages while others don't. So depending on which one you're dealing with, you need to know what advantages you'll be having. Now, in that sense, rates have also the tax advantages and the likes. That is, if you hold a rate for a certain period, you don't have to pay capital gains taxes and the likes. But with real estate, unless you're doing your books right, chances are you'll be paying taxes on probably a yearly basis. But with rates, you can skip some of that paying tax by holding the investment long term. So the evolution of real estate investing has gone from physical buildings to multiple buildings owned by multiple investors to now real estate investment trust ETFs, or like real estate ETFs, where you have an ETF, which is a collection of rates and real estate related stocks. And this ETF generally does real estate. And then you have this ETF, you can invest in that ETF, and now they invest in multiple rates and multiple real estate related companies, and therefore maximizing that sense of diversity. Because in a physical or a traditional real estate investment process, you could only have a house. That is, if it's a single family house, you have one single family house, and then you make profit, you save your money, you build another one, and you keep doing that. And then chances are you'll probably be just involved in single family households or apartment buildings. But chances are, if you're doing that, you will not do commercial buildings, or if you're doing that, you will not do student living buildings. It kind of restricts you to almost one niche of real estate, while rates or real estate investment trust give you a sense of diversity, in the sense that you could own a REIT that does apartment buildings. You could own a REIT at the same time own a REIT that does student living. You could own a REIT that does commercial buildings. You could own a REIT that does let's say stuff like business wise things to do, like I think the idea behind something like McDonald's is mostly real estate, because they own the places where the McDonald's are built. So, and they franchise the franchise to the people, entrepreneurs, and these people end up paying more in terms of rent to the McDonald's franchise than even the franchise itself. So there's lots of ways where REITs does investing, and through real estate investment trusts, you could buy several of them. Through an ETF, you could buy multiple, 200, 300, 500 of them, and own a variety of real estate investments without actually owning a building yourself. So that's more of just the discussion about what real estate investing is, and the evolution of real estate from the traditional sense of real estate investing to the modern sense of real estate investing. There's a lot that goes on into that. For example, you could have something like mortgage companies. A good one is like Housing Finance. Housing Finance in Kenya is a mortgage company, and you could have an ETF that has that as part of its portfolio. So therefore, you could be owning real estate, but through mortgages, because Housing Finance, they, for the most part, they don't own buildings, but they give out mortgages to people who own buildings or housing that is real estate. So there's different chains of investment that can happen between you as an investor and the investment, in the sense that you could have someone owning the building, but they took a mortgage from Housing Finance, but Housing Finance now is owned by an ETF, or is in as an ETF is investing in Housing Finance, and therefore you as an investor, you invest in that ETF, and that creates a chain of investment where one person invests in something, and that person invests in another thing, that invests in another thing, and goes all the way to the actual real estate property. And this helps with stability, because one, if you had just if you owned a house, and all of a sudden the area in which your house is located has a bad reputation of robberies, then your rent will probably go down, because nobody wants to live in a neighborhood where you get robbed all the time. So out of nowhere, your rent could just go from whatever amount you're getting to almost 0%, or maybe 50% or 20%, based on whatever activities that is happening around you. But with, say, REITs investing through an ETF, or even just REIT by itself, a REIT could have 15, 20, 30 different properties across different variations. So yes, an apartment could be located in a neighborhood that has issues. They don't collect a lot of rent, but there's another commercial building in downtown where they're making good money out of. So that balances that volatility in that investment, in that there is no way your investment could just drop out of nowhere without something serious happening in the economy. So investing in a real estate investment trust gives you that sense of security against risk, among other things. So what we want to look at now is, how do you find these real estate companies and how do you invest in them? So just like before, our go-to tool is Finviz. You go to Finviz, and what you want to do is go to industry right here. Previously, we did exchange traded funds, but now we want to look at real estate. So you scroll down and you go to real estate right there. So there is different versions of real estate. So you can see there is real estate development, real estate diversified, real estate services, real estate residentials, real estate rates, real estate leasing, residential and construction, and the likes. So what you want to do here is pick an industry that you're interested in real estate. For example, you might want real estate development companies, which is their job is to develop real estate properties. So they're the guys who construct, let's say, commercial buildings, or they're the guys who construct residential buildings. Or if you want something that is diversified, that they do different varieties of real estate, you select the diversified. If you're into real estate services, these are companies that offer real estate service, just like property management and the likes. Okay. If you're into mortgage, so if you're in tune with how mortgages work and you know you can make money through that, you can invest in a mortgage rate. They're really good because people are always buying houses. People are always spending their money in mortgages to get houses or commercial buildings or whatever. So, and companies that cannot afford to buy or to build a building would most of the time get a mortgage to build that building, and industry and the like. So, depending on your preference, you come and select real estate type or industry that you're interested in. But for now, we'll look at rates, diversified. So they invest in several different kinds of rates, real estate buildings. And when you're looking for these companies, you might want to just do real estate diversified or rate diversified, and that will give you more of the whole industry in general. So let's do rate diversified, and we see what we have. And now here you can see that under industry, under sector is real estate, everything is real estate, and under industry, it's a real estate diversified. So these are real estate companies, and what they do, whatever they do, you'll then look into them and see what they do. Now, after selecting that, what you also want to do is make sure that you are choosing a rate that gives you a good dividend. So, like previously when investing in dividend ETFs and ETFs in general, you want something that can give you around at least 3.5%. So when you are filtering, you select the dividend yield and select, say, over 3%. Okay. So this will filter down the companies to, you can see here, 24. And then the other thing is you want something that has some sense of liquidity, as in you don't want to buy a company that you'll hold for like forever. You want to buy a company that if you want to sell it today, you can sell it, or you want to sell it tomorrow, you can sell it. So that's where you come to relative volume or current volume. Let's say average volume is a little bit better. You want something that does on average around over 300K. That's relatively okay for real estate. Okay. And now here you have a total of around 12 companies in which you can now go further into and filter out what and see what they really do and the likes. Now, from experience, I know a few companies here that really do good. And one of them is this VICI. That's a very good real estate rate. And STORE, which is Store Capital Corporation, is a very good rate. And this one here, Essential Properties Realty Trust. Very, very good one. So just to, easen up on how we're doing this, I'll look at, say, this VICI. And remember the process. You go to TradingView, then you search for that VICI. And it will show you VICI Properties Incorporated. Make sure it's NYC, New York Stock Exchange. If not, it's NASDAQ. But the symbol must match the stock exchange. So this is the one you're looking at. And let's have a load. As you can see, within just last year, from last year to date, it's been pretty almost stable. It's not been going up and down too much. And they've been consistently paying out dividends, I think, every 3 months. So you can see that there's dividends every 3 months. Over here, you can see they pay out 5.12% in dividend. So that's good. Volume is there at 5 million. So very good volume. So which means there's a lot of activity in this company or rate. So if you're buying it, you know for sure you're buying, you're making your profit, you're selling, you're making your profit, and the likes. No holding for too long and similar kind of things. Now let's zoom out a little bit and see performance over time. How has it been performing from like several years back? And you can see, I think they started. The company started in 2017 or 2018. I think, yeah, around there. Where is this? So ever since that time, you can see it was growing steadily, despite the dips, but it was growing steadily. And then Corona happened, and the stock dropped significantly. And as you can see, the recovery was very, very impressive. So from just March of 2020 to June of 2021, it had already surpassed its previous high before the virus. And then after that, it's been just stagnating, not really stagnating, but, it's been stable around that price before Corona, and then the high. So it's been just fluctuating in between there. And so this gives you an idea of what a rate looks like on a chart. So you can just buy this VICI. What are you looking in terms of dividends? Dollar-wise, they're paying 30 cents every, I think it's like almost every three months they pay 30 cents, and the likes. Now, from you knowing what this rate is all about in terms of the technicals, you can also go and look at their finances, and you can see they pay out 87% of their dividends, their profits in terms of dividends to their shareholders. You can see other metrics here and there, analyst ratings and the likes. So this seems to be a good rate to invest in. And now we want to know, if you invested in this rate, how much should you be expecting in terms of returns? So let's go to our stock return calculator, and we put that VICI there. Then we want to invest in this rate from, let's say, from January of 2018, and see what happens. January of 2018 to June, which is now. Okay. Let's see. And here we have, this will give you an annualized return of around 11%, total return of 59%, average return of 30%, and if you had invested $1,000 into this, by now you'd have $1,500, and that's just growth of the company. But then we want to look at, say, dividends, and see how much dividend would you have earned through it. Because the key with the real estate investing is the dividend, earning dividends. So this stock is now $29. Oh, let's look at the price back in 2018. It was $18. Okay. So we go back here. We say price was $18. We want to buy an equivalent of $1,000 in this thing. So back in 2018, $1,000 divided by 18, you would have bought 55 shares of this rate. So we do 55, and then annual dividend is 5%, 5.21. Then we want to see dividend growth. I don't know if it shows here. It doesn't show the growth rate. I think I need to find that out. But let's do an assumption of, let's say they just do 3% growth. Then annual growth rate of the stock is, we saw that was 11%. A number of years, 2018 to date is 4 years. Something like that. Okay, let's see. So total value of that investment would, without you taking out the dividends, would have grown to $3,561 when you would have invested $1,000. So that's 3 times growth, at least 3.5. Your shares would have grown from 55 to 130 shares. Dividend paid would have been 1,800. So this is almost double how much you had invested in this rate. You'll get double of that in just dividends in that time frame. And then annualized return, you're looking here at 37%. So what this is performance. Like I said, money market funds give you 9, 9.5, 8.5, 9, 10, 12, maybe. Investing in this rate would give you 37% annualized return when you do dividend reinvesting. So just like that, you're doing 37% in this investment. Now, if you do without dividend reinvesting, you can see here your total value will have grown to 2,700. Your number of shares will be the same because you're not reinvesting the dividends, and then you'll get around $1,200 in dividends in that time frame. So in that 4 years, you're getting $1,200. So it's like around $300 a year. Not a lot for $1,000 investment, but as you can see now, that dividend reinvesting is way better, gives you a way better outcome than not reinvesting. And now, when it comes to annualized performance, you're looking at 28%, which is even way better, almost 4 times, not 4 times, but double, at least double what other investment vehicles are giving out there. So you just want to have a portfolio with similar rates. You know for sure that you can have a good outcome in the process. So that's the performance expectation of investing $1,000 in a VICI. And then we can do that for the other stock, which is a store, the rate. But I would think, it's more or less the same. So the whole process is, again, you go back to TradingView, you do the stock symbol. It's a Store Capital Corporation. You look at the performance across time, and they started in 2021, I think, right there, April of 2021. No, it's still loading. Yeah, patience. Okay, they must have started a little bit longer ago. There you go. Started a long time ago, back in 2015. What do they? What does the dividend look like? They're doing 6% in dividends, as you can see right here. They're paying more than 100% in dividends. They're doing 137% dividend payout, which means, you're getting more than you had invested out of this thing. Expected returns, that is. So they're probably very profitable. They're probably doing very well. So as you can see, good returns with this one. Right off the bat, right there. If you want to do dividend calculation, what was this back in 2018, and the price of this was $24. So $24, you're trying to invest just $1,000. So 24, you'll buy around 42 shares of this thing. Then it's $24 a share. Annual dividend paid. Oh wait, it's around $5.76. Okay, $5.76. Growth rate, I'm thinking they have a little bit better growth rate in dividends. Let's see something here. Performance wise, I know they're probably doing better than VICI, but let's just see. Store January of 2018 to date, and let's see. Okay, they're doing 23% total return. Analyze is 4%. Something doesn't make sense. $1,000 grows to 1,200. I'm assuming maybe they were making losses some time back. That's why they're now paying more in terms of dividends when they started making profit. So some of these things, you learn them through research. You find out that the numbers you're looking at, why are they the way they are, and the like. So just looking at Store, we figure out that there's a lot going on with this company, and I think the recent years it's probably been doing good. That's why they're paying out 137%. But maybe the previous years they were not doing so good. That's why the average has come back to 4%. But the process was we found the growth, and then we find the stock performance in that time frame. It's 4.8. 88, same 4 years. They must have done not so well back a few years ago. And as you can see, actually, that's the case. Store wouldn't have done better than VICI. And that's where you might have to go to the fundamental analysis of this and see what happened in the last probably a year, 2 years, 3 years before this year. So something must have happened here with the corona and everything that dropped the returns significantly. But anyways, as you can see here, this doesn't do so well, but recently it's been doing good. So if you're starting to invest in this company right now, chances are it will do better given the current data. So that's something you can do. But yeah, so we've gone from finding the stock from Finviz. What we've seen is you can filter out exactly what you're looking for, get the exact dividend expectations, volatility, growth, and the likes, and then calculate your expected returns based on past performance, and then go on like that and figure out, what this is all about. Now, the next thing I wanted to share is the ETFs. Just like we've done with the rates right here, we'll go to our what do you call this? ETFdatabase.com. We want to look at the screener, and then under this screener, we want to look at real estate right there. So that way you just get exactly what you're looking for. We can also filter with real estate. Do you want the broad, which is diversified, or do you just want industrial and office, or do you want mortgage rates, or do you want residential rates, or do you want retail rates? So with this one, we might say we just want to look at broad aspect of that real estate sector. Now, I had done previous research, and this XLRE, which is S&P 500 real estate ETF, index fund. Yeah, so this is the site, the SPDR ETFs and index funds. This is the site, and here you can see we have the real estate index and the current price and the likes, and you can see their performance over the last several years. So annualized performance in the last 3 years, they've done 10%. In total asset returns in the last 5 years, 10%. 10 years, nothing. I'm assuming they hadn't formed the company, the ETF before then. So far, a 10% rate ETF. This is the S&P 500 ETF. So this would be a good investment as such. So you can look at it and look at their portfolio, see which companies they invest in. And here is when you'll notice that the companies that they invest in are mostly rates and real estate related companies. Okay, so as you can see here, American Tower is one of the best performing rates. Next to that is Public Storage. I know of them, they do really good. Real Estate Income Corporation. This is good for if you're looking for income. They really do a good job income-wise. So as you can see here, a lot of even this Simon Property Group, very good. Welltower, very good. So they invest in the top performing real estate related companies. And therefore, if you are trying to invest in real estate, this would be your best choice of investment. So, like I said, you go filter for ETFs, real estate ETFs, and then you go through and look at what they have and the likes, and then you pick out the best performing, and you see and analyze it. Now we can filter, we can sort it out by dividends and say we want one that does the highest dividend. And right here, you remember Global X, the ETF company. They also have a real estate ETF. It's called SRET. Then let's just do that. Look at that, like the previous symbols or companies. So Global X is a ETF issuer. They have real estate ETF, and here we can see, look at that, dividends like crazy. Okay, they're doing 7.75% in dividends, so which is really good. Despite the drop of 2020, it's been stable so far. What else? As you can see here, seems like so this is December, January, this is what, February. Let me just click on it. So February, March, April, May. So it seems like they're doing monthly. So if you're looking to make monthly income through rates, this Global X rate could be your best option. So that's how you find a rate, an ETF related rate, or an ETF investing rate, rate investing ETF. We can do the calculation and see just performance wise. We don't want to go so far into the whole situation. Yeah, so performance wise, that was SRET. We want, let's say, just like the other ones, let's just do January 2018 to date and see annualized performance. They're doing negatively, and that's because you see here they're below their previous high from the corona drop. But it's something that it's looking like it's going to stabilize and recover from. And if you're investing from now going forward with the 7% rate distribution, chances are it will be a good investment. Let's try and change one thing here and see what it looked like if we were doing it 10 years performance wise. So still, I think the recent drop has really significantly impacted the performance of this ETF. But the point is that given that is the highest performing dividend wise, going forward, chances are it's going to perform better over time. And if you want to know their holdings, like I said before in the ETF discussion, you click on that ETF, then you go to holdings right here. Then under holdings, you can see what companies they invest in and what are they all about. So as we have it load, we'll see in a moment right here. Just from their page, their initial page, you can see they invest in global rates, real estate rates, a multi-factor and the likes. The volume is around 198,000. So not so much in terms of volume. You want something that is around 300K. Okay, so this is breakdown by the cheapest and the most expensive, companies. Oh, these are alternative investments. So alternative investment, this is performance. Where is the holdings? Yeah, these are the holdings. And as you can see, some common names start showing up, like this WP Carey was there in XLRE. I know Eckers or RS Commercial is a good one. Blackstone Mortgage is good. So all in all, what you do is take this information, use it to structure your investment. If you're into real estate investing, this would be a very good way of investing in real estate. And other than that, I think that will sum up this webinar for the day.